interest rates are likely going to rise. Stocks are near all-time highs, perhaps overvalued. There's a potential for a double whammy. What are the pros and cons of moving from stocks and bonds to money market funds until the market stabilizes?
Well, I can think right away. Beginning of the year, we all thought the equity market was going to have a correction sometime soon. There was a lot of talk amongst Wall Street pundits and the rest of it. And I know quite a few people who reduced their exposure to the equity market in anticipation of such an event, which never came. You know, it's a major decision when you go ahead and make a significant change in your portfolio's diversification and the rest. And so you may go ahead and miss whatever the opportunity is that comes up as a result of it. Typically, you know, for investors who are concerned, they may want to consider de-risking the fund to some degree. Maybe taking some of those assets and putting it in something with less risk. And money market funds can be another opportunity, especially if there's going to be this double whammy that takes place in the market, because that would give him an opportunity to go ahead and step back in and buy potentially at lower prices. So we see people use the money market fund that way. As the markets are taking off and heading north, a lot of times I'll see the flows tend to go ahead and be more to the outflow than to the inflow side, and can reverse again when the stock market moves in the other direction. So that would be a strategy, you know, that could potentially be employed.
And as David said, we definitely encourage our clients to maintain that discipline in a long-term perspective. So there's a strong temptation when you think that the markets are going to sell off to sell in your portfolio or to market time, but our research shows that typically that doesn't pay off if you try to market time. You want to maintain your investment plan over time. As hard as it is, it's really hard to do that. But the research shows, for example, if you had sold your equities during the financial crisis, you would have missed out on the upside. And we conducted research over a very long period. We looked at 1997 to 2012. You can find this information on Vanguard.com under Investing Principles section. And it really demonstrates the benefits over time of maintaining that long-term perspective. Rebalancing is crucial when the markets are volatile. Our research shows that even though it might seem counterintuitive to clients, you definitely want to maintain your desired asset allocation when the markets are moving up and down. If the markets move and your portfolio changes by more than 5%, you would want to rebalance. You would want to take a look at your portfolio at least once a year to rebalance as well. And the other thing to keep in mind is that if you make big changes in your portfolio because of such an event, you're going to incur fees and costs. And taxes as well if you're trading in a taxable account. So that'll reduce your returns over time as well.
For more information about Vanguard funds, visit Vanguard.com or call 877-662-7447 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although a money market fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in such a fund.